Hey guys, it's James and I'm back with another valuation video. I'm going to be looking at GPC today. GPC is Genuine Parts Company, founded in 1928. They have two business segments, one segment in the automotive parts group and another segment in the industrial parts group. When you think automotive parts group, think Napa Auto Parts, very similar to O'Reilly's and AutoZone. And when you think industrial parts, think things like Milwaukee Tools. So we're not going to get too much into what exactly this company does. We are going to look at some of the technical and things behind GPC to be able to see what type of valuation we can get and compare our valuation against the current price and see if this stock is either a buy or sell with the margin of safety that we apply in this video. If you guys want to follow along with this valuation, you can download this spreadsheet over on my Patreon, as well as a whole bunch of other spreadsheets that I have put together. So starting with GPC, we are going to evaluate GPC using the discounted cash flow model, Graham's model, and the dividend discount model. We're going to average these three evaluations together and come to a final evaluation and apply a margin of safety. So to get started with the DCF model, or discounted cash flow model, we need 10 years of free cash flow. So where do we get these numbers? Well, over on the macro trends for Genuine Parts Company, they have the free cash flow numbers available. So we're going to go ahead and translate the numbers from 2012 all the way to 2021. And these numbers are read in the hundreds of millions. So for 2012, there was $812 million worth of free cash flow. And in 2021, there was $1 billion worth of free cash flow. So let's go ahead and transfer those numbers over right now. And we are reading in the billions over on my spreadsheet. You can see the annual free cash flow numbers. There has been some ups and downs, with a fairly large spike in 2020. And that spike was around 224% growth year over year. So the average growth is represented by this red line here. So if this red line were to continue of about 19.31% average growth per year over the past 10 years, that is the average free cash flow growth. And then next thing we need in the discounted cash flow model is the perpetual growth rate. Now typically for this figure, we're going to use anywhere from between 0.5% to 2.5%. This is saying if GPC were to grow into the future, infinitely into the future, thousands of years from now, what is the expected perpetual growth rate? Well, typically we're going to be choosing a number around 1 to 1.5 for our analysis. And today we're going to go ahead and choose 1.5%, and you can do your own analysis as well. But today we're going to do 1.5. The discount rate, typically that is going to be about 8%. Now we have to find how much cash they have on hand and how much total debt they are currently holding. You can find that over on Seeking Alpha. You come over to Seeking Alpha's page for GPC. Under their valuation tab, they have total cash $629 million and total debt of $4.04 billion. Come back over to the spreadsheet and we'll go ahead and put those figures in right now. So with those numbers in the calculator, we come to a valuation for the DCF model for GPC for a total value of about $421. Now this is one of the reasons you apply a margin of safety. The growth rate here for GPC is probably unconventionally a little high right now, just because of the 2020 free cash flow numbers, and we probably should not expect this to continue. So if we had a lower growth rate, this discounted cash flow model valuation would be a little bit lower. But let's continue with Graham's model and average these three valuations out. So for GPC, the growth rate that we put in Graham's model is the expected growth rate 5 to 7 to 10 years from now. And that's going to be, the analysts are saying, around 8%. Then we need the AAA corporate bond rate, and we can find that by a quick Google search. And today's AAA corporate bond yield is 4.69%. So let's go ahead and put that in the calculator, 4.69. and that gives us a Graham's model valuation of $117 for GPC. Everything else that you need for Graham's model is inputted into the formula that is being calculated right here. So you would only need these two figures. Now on to the dividend discount model, which I really like this type of model for GPC because they have been, GPC, Genuine Parts Company, has been growing their dividend for close to 65 years. So this should be a fairly close, accurate number for the valuation for GPC. So where do we get these numbers right here? Well, we can head over again to Seeking Alpha, and on their dividends tab and their sub-tab dividend scorecard, we can pull some of the numbers that we need. We see their dividend growth rate is close to 65 years running. Their 5-year growth rate is 5.46%, and that's their 5-year dividend growth rate. And then we also need their annual payout of $3.58. So let's go ahead and put $3.58 and 5.46% in the calculator. So $3.58 and 5.46. 5-year dividend growth rate. Now the risk-free rate is just simply the 10-year bond yield, and the 10-year bond yield currently is sitting at around 3.73%. And then what is the expected return of the market over the long term? Well, it's going to be anywhere from 8 to 12%. And for this calculation, we're going to do 8%. So we come now to the average of these valuations. $143 for the dividend discount model, which is probably closer to what this stock is worth. We go ahead and we want to apply a margin of safety. Yes, the margin of safety, we're going to say a little bit higher for this stock because we do have that spike in free cash flow. So I would not choose probably anything less than 25 or 20% for this stock. We say go. The average valuation comes to about $227. The final valuation with a 20% margin of safety gives us a buy price of $181. We go a little stronger margin of safety of about 30%. That gives us a final valuation of $159 with the current price of $184. So the cutoff for margin of safety for a buy and sell is around 15% with these inputs right here. 20% would evaluate this as a sell. If you guys want to follow along with this video series here that I am doing, I'm going to be going through these dividend stocks and putting the date that I do the valuation and the valuation that I come up with, and compare that with the price of today. And I will periodically check this list, and as this price fluctuates for each of these dividend stocks, we'll see if any of these valuations do change for these dividend stocks. So for today, for GPC, today's valuation with a 20% margin of safety is $181.86 compared to today's price. We also have from the website FinViz, we are pulling the analyst rating data, and the analysts are saying that GPC currently is a hold. Here's the PE ratio, here's the 52-week, well, this would actually be the 52-week high, and this would be the 52-week low. So let's see what this would actually show us if we did have a valuation higher than the price. Let's say we had a smaller margin of safety, and let's say we came with the valuation at $195 for GPC. Well, then this would give us a signal to take a look at GPC again. Maybe they had a very good earnings quarter and their valuation increased. And this valuation is taking into account today's price as well as the valuation. So remember, every day these prices will fluctuate compared to your valuation that you did on a certain date. So if you guys would like to follow along with this series, you can download this spreadsheet over on Patreon. And with that, thanks for watching.